So in the last video, I said that I would try and look a bit deeper into the Harley-Davidson situation, with the fact that they sold a load of their loans to KKR and PIMCO. I was waffling on a bit, to be honest, towards the end of that video, but I think it got quite late. I wasn't really thinking properly, so I called it a day. But I've been looking into it just to see whether or not there is value, because I think we looked at that Steve Canalfa article where they were claiming that there could be a lot of value to unlock in the finance arm. So I've done some research into that. I have finished the research into that, so I will talk through it. One of the things I just noticed though is that since the last video came out, I mean, what was that, a week ago now? I mean, I'm just the way my life is at the moment. I'm not able to continue to get videos out as much as I'd like to, unfortunately. But we have this on 29th and 2nd. It's the wrong way around. These dates, but yeah, on the 9th and the 2nd, we've had, not insignificant insider purchases. One of them's almost 300 grand from the CEO, 1910, and the current price is obviously 17.97. So, something in that. I did notice as well, though, that there is, I think it was Wells Fargo, they're setting a price target of $15, which is obviously quite a bit below where we are now, and sort of in line with the COVID lows. But when you see what happened in COVID, when we came out of COVID, look at, not that I'm saying that's going to happen at all. I'm just saying, look at what price did when we were last in this area, multiple times now, actually, when you look at it. Down here again, it's gone on some decent runs from down here. So historically, this has been like a sort of floor, and this price area, and we're actually going to see that in some of the analysis that I have done. I don't really know how I'm going to do this because it's going to be boring to watch, because it's going to be a lot of talking. I have put together a document here. I have shrink that. Hang on. There we go. It's just going to do that all the time. All right. Technical issues. Look, good quality watching. Right. Anyway, here we go. So, in the finance arm, this understanding that Harley-Davidson financial services, they basically sold $5 billion in existing loans to KKR and PIMCO, and they bought 4.9% of the equity each. So going forward, so that's 9.8% of the equity of Harley-Davidson Financial Services is now owned by KKR and PIMCO. Going forward, 2/3 of new loan originations will be sold to KKR and PIMCO for a small premium above the total value of the loan origination. So basically, they're getting Harley-Davidson Financial Services, HDFS, is getting it off of their books pretty fast. It will continue to be the administrative face for Harley-Davidson. So even if your loan had been sold to KKR or PIMCO, you would ring up Harley-Davidson. Harley-Davidson would deal with it. So for Harley-Davidson still dealing with it, they're charging a servicing fee. Now, I don't believe any of this stuff has been put out there, what the cost is going to be. Grok reckoned it was be about 1.5% above the loan value, so premium on the loan to sell it, and then potentially around about 2% for servicing charge. So obviously that's significantly down on the, if you're keeping the loans and you're earning the finance all the way up to maturity, and say the loan, the interest rate was like 10%, that's going to be significantly below. The thing with that is that they've de-risked the balance sheet in that if those people don't default, then that is on KKR and PIMCO, and it's not on Harley-Davidson. So I said it here, like the earnings will be smaller and the percentages earned from these loans are now much smaller, but it also helps them manage the risk and delinquencies and charges off, so now not on their books but on KKR and PIMCO's, what I just said. The deal unlocked 1.25 billion in cash for Hog, and they used it to pay down some debt. That also means that the 1/3 that they're not selling, they are keeping. So they will fund those loans as normal. They'll take the interest all the way up to maturity until the loan is paid off, and that will go directly to HDFS and then Harley-Davidson. KKR and PIMCO pay 46.6 million for 9.8% or 23.3 million each. Their 4.9% portion. This means the implied value for 100% of HDFS is 475 million. Now, 475 million came from the management, and they stated that the deal was priced at 1.75 times equity. So that was what they viewed as fair value for the finance arm at that time. So peers trade around about 1.2 to 1.5 times book, and I think the peer used there was Ali. So the premium, the 1.75 supposedly reflects the brand plus the fee potential. So the actual equity value of the portfolio, say it was 1 times book, would be 271 million. So to get that 175.5, which is what the what it was priced at when they sold the 9.8% to KKR and PIMCO, divided by 1.75, and that gives you a 1 times book value 2.7. What's going on there? Sorry, 271.7 million. So a while ago, I did a video on First Guarantee Bank Share, FGBI, and really like that. And unfortunately, let's have a quick look here. Unfortunately for me, I was literally looking at it down at the lows, and then this happened. So I didn't get in fast enough. I've done a video on that. I only valued that, I believe, at 1 times book. There we go, Hog. Yeah. Big debt, but there was a much higher potential for delinquencies and charge-offs, I believe, with FGBI than there currently is with Harley-Davidson. The only problem we got with this new deal is that it's very difficult to model HDFS earnings will be going forwards. Obviously they're going to be down what they was previously. Grok states that the Grok was saying that the best way to do it is just take the management's estimates at face value, and the management was saying 45 to 60 million in operating income. As time goes on, obviously, and they build up their loans, the 1/3 that they do keep, then they're going to earn more interest because they're going to hold more loans. So there is chance for scaling of the earnings, which is where I think maybe that Seeking Alpha article was saying that some of the value could come from. So yes, there is the potential for scaling. Origination volume is directly correlated with the HDMC, so Harley-Davidson motorcycle shipments, and 2026 guidance is 130 to 135,000 motorcycles. Historical norms is around about 150 in good years, but Harley-Davidson's a very cyclical business. So for the earnings, so 45 to 60 million, if you did it on a peer basis, yeah, let's say put there Ali, trades at 10 times earnings, so that would be 450 million on the lower end. So we're using the guidance of 45 million times 10 times earnings is 450 million. The other thing was book value, 1.2 times book. Now 0.2 to 1.5 times book, which is what Ali also supposedly historically trades at. I used a 271 million, obviously, because you're doing times book. And that came out at around about 326 million in book value of equity. So that factors in flat originations and no rise in delinquencies, but delinquencies did rise 0.4% year on year. in selling the 5 billion loan portfolio, they have de-risked. 8% of the revenue supposedly comes from HDMC, which is highly cyclical. So what we did then was me and Grok, me and the AI, normalize what the average earnings would be in a conservative mid-cycle, and that would be around about 200 million. Apparently the average cycle is 325, but we've adjusted that down to be conservative by 30 to 40% to account for ongoing tariffs and the aging rider base, because that is one of the huge problems that Harley-Davidson is going to face, is that the rider base is aging. And if no younger riders, Gen Z or whatever, wants to get into it, then they're going to sell less bikes. That's just how it is. So given a conservative value of 200 million times 10, the earnings is 2 billion in implied operating income. So if you add the HDFS 450 million to HDMC 2 billion, you get 2.45 billion in operating income. So subtract net debt, so total debt is 2.967 billion, cash and equivalents is 3 billion, so it's actually positive, so you've got a plus 125 million. Then you'd have a final equity value of 2.575 billion, 114.3 million shares outstanding. So on a net debt operating income multiple, you're looking at like potentially $22.5 a share. I haven't put the electrical vehicle portion of live wire in, quite small. So yeah, it just didn't seem like a big enough thing for me to put value into it. So obviously this is the Seeking Alpha article that we read said that there could be some upside, and there could be some upside if the HDFS scales the 1/3 of loans that they are taking. I think they said they believe that they could earn by 2028. Have I got it wrote down in here? By 2028, I think they said that they could potentially be earning 200 something million a year on the loans. I haven't wrote it down in here actually, but yeah, so there's definitely room for scaling when their loan portfolio builds up. Obviously, the larger the loan portfolio, because they've sold a significant portion of it off, then the more interest they're going to make on that. So there's definitely room for scaling over time, which would significantly change at least the HDFS's portion, which is what I think some of the people are getting at when it comes to finance arm post-deal being misunderstood. The only other thing that I did was I just wanted to know what a reproduction, like liquid reproduction value for the business would be, just to value it purely on a book value of equity thing, just so I would know what my potential absolute floor would be, my margin of safety effectively. So how do we start up here? So inventory, 731 million in book. The fair market value could be between 658 to 804. This was all done on like a percentage range. They're right what percentage range is, around about 90 to 110% on fair market value. To be honest, that's quite high for me. Generally, this is what Grok was suggesting. Bruce Greenwald's book is quite good for that. He gives like percentages of what he thinks that you should take for liquidation, value analysis, or whatever. I can't remember what the book's called actually, but it is definitely worth reading. It's got his earnings power value calculation in it. Anyway, I've gone down through everything for HDMC, HDFS, and I did add the live wire assets into this. So total tangible assets was around about 6.8 billion, 6.9 billion. It was 4.9 billion total liabilities. So per share, 16.97 in total tangible liquidation value. So that's not counting the actual value of the Harley-Davidson brand name. Now, Harley-Davidson, whether you like their motorcycles or not, I am a motorcycle rider. I did almost buy a Harley. I went for a Triumph instead. So I got nothing against Harley-Davidson, but I know there are a lot of motorcycle riders that, especially in Europe, that sort of turn their nose up to them. But I personally do like the look of some Harley-Davidsons. I know they're not as reliable really as the European bikes, but it is a huge brand name. Harley-Davidson is a big brand. In the motorcycling world, the name carries weight. So that's an intangible thing that I have not added into the valuation, the equity valuation. Harley-Davidson's brand name has value, absolutely has value. It's on t-shirts, it's on, mugs and blooming all sorts. You can slap a Harley-Davidson logo on a product and it will sell. There is value to the brand name, but that is an intangible value, and I've not added that in because generally when I'm doing my liquidation or reproduction value, I don't tend to add the intangible of that into it. I just go on the absolute tangibles of it. So what I find reasonably interesting is that I've got a tangible liquidation value of around about $17, $16.97. Well, it's not too far off what Wells Fargo have just not too far off what they are saying, $15. So I mean, if $15, say it got down to $15, which is in line with previous lows, we've already talked about that. If it got down to $15 and you do have room for the scaling of the financial services over time, it could very well be undervalued at that price. I mean, the internal buy-in here from the CEO buying $300,000, there's only one reason he's buying, isn't it? They can sell for multiple reasons. They could have tax bills, they might want a house, they might want a car. They can sell for multiple reasons. Generally, they only buy for one. So is he looking at a longer term thing with the scaling of the financial services in there as well? I don't think there's a big enough upside for me. I'm too new in my analysis, in my journey, for me to go, oh yeah, I want stuff that I think is like 150% undervalued, because if I'm wrong, then hopefully at worst, I could still make 20-30% on it, It's so difficult with this because you don't know how the new financial services deal is going to pan out. That for me, I'm not willing to take a risk on it effectively. I would definitely keep it on my radar. Let's say for a long-term thing with the scaling of the financial services. Should it keep getting lower, then it could be something that I would look into. I do sort of now I have an understanding of the deal with the financial services. I do sort of understand the thesis of the people on Seeking Alpha saying that financial services part is misunderstood. This is where there could be significant growth. And I agree, there could be with that over time. So we will see. I'm not confident enough to invest in it. The floor value of floor value of 16.97. We're still above that. I don't tend to enjoy buying above what I believe is pardon me, I got another cold, believe it or not. I don't tend to like buying above that. I want the margin of safety from the assets. or from the cash flows, and the cash flows aren't really high enough, and they're going to be getting smaller, at least forecasted for the foreseeable future. Hogging here, yeah. So I don't know. For now, it's a pass, but it is gonna go on the watch list in the blue. I may even do a bit of technical analysis here. Got to look around down here, I would say, for the price floor. Go all the way back. All the way back. See if there's any previous sort of correlation around this level, which there is. Stopped previously in the past, broke through, rebounded, went higher. Every time it's been around this level, there's been significant movement one way or the other, generally higher. So I might even put an alert down around here. Expiration. I want it more than a month. How far can I go? Till May. I've put an alert on it. We'll see what it gets to. If it gets down there, I'll see how I feel about it. On a long-term play, I can see there could be some value in the financial services, even though they've sold 2/3 of their business off. We'll see. But for now, that is. I said I would start the next video after I figured out what was going on with Hog, and I hope I've sort of semi-explained it. We will just wait and see what happens on that one. To be honest, there has been good movement every time from this area, but past performance is not indicative of future price. What was the last article? Why Harley-Davidson's shares are trading lower. Wells Fargo's $15 price target. Is there something that doesn't? One of the big banks is saying, "Oh, we reckon 15," but CEO purchased around 300,000 at closer to 20. I gotta be honest, right? I don't put a lot of weight on a lot of this analysis stuff. I like to come up with it myself. I've heard a lot of value investors, Burry, Pabrai, Lee Lu, and they don't tend to care what anybody else thinks. It's what they think, and obviously they are phenomenal investors. But effectively, what they're saying is you can't be worried by the crowd. If you're a value investor, you are constantly going against the crowd. That's just something you got to be used to. It's probably something psychological makeup that allows you to do that. You've got to be comfortable being on your own. Anyway, so that's Hog. We'll move on now, see what else we can do in the rest of this video. I have looked at Criteo before. Now, off the top of my head, I don't know what it does. I'm sure it's what I got in one of my early videos. It's got Criteo in it. It's an advertising company. Yeah. So, I'm guessing it would be along the lines of WPP. A lot of advertising companies are really struggling with AI coming into the business. It's probably not something. I mean, there's a reasonable range here, isn't there? Technical analysis again. I keep saying I'm not a technical analyst, which I am. But it is interesting to look at this price. There's a range here. Dropped out of it in 2020, but there's definitely a range there. Not too big on advertising. After looking into WPP, I'm not too big on advertisers at the moment. It seems like the future of that industry is going to be very difficult. No purchases since November. Even then, it's not a significant different, is it? I mean, it's more money than I've got, but anybody else? Let's have a look. Okay, so they got some confidence in it, 8.9%. No one else has, though. If they're not really, I suppose you could say 3% maybe. Let's just have a quick look, shall we, at the balance sheet. I'd imagine there's going to be negative tangible book with a company like this. And given the headwinds of the industry with AI going forwards, I think we're just going to pass on this. Where am I looking? Shareholders equity. Nope, is that not what we want? This one here, sorry, it's right at the top, statement of financial position. So 340 million in cash. Receivables, so current assets are pretty good, even if you only took like 80% of that. PP&E, 130 million, intangibles and goodwill, that's significant, isn't it? 650 million. Right of use assets as well, leases are worth nothing in liquidation, generally. Can't use any of your tax assets or anything in liquidation. So what are we saying we've got? PP&E. We're basically saying we've got about $1 billion, aren't we? Cash, receivables, PP&E, marketable securities. Amount of investment in marketable securities. Okay, so there'll be some value in them. Fuck all though, innit? And it seems it's not even worth that. It's not even worth totaling up. So you've got like $1 billion. Then you've got $1 billion in total shareholder liabilities. I mean, not a lot there, is there? For downside protection. And as I've said previously, if I get my tracker up and we go, I'm just scrolling up to it off screen a minute. Let me go here. So I am looking for downside protection first and foremost. Now this is I've changed the way that I invest, and if I cannot get downside protection, then I'm not interested, and I need to have reasonable downside protection, either from liquidation. On me, just knocked my phone on the floor. In liquidation value, reproduction value, in a business that's not effectively going bust. Bruce Greenblatts here states use liquidation value for non-viable businesses and reproduction value for viable ones. So it doesn't need to have just that. You can have earnings that are so great that they're going to pay off the debt. They might not have a lot of downside protection, but the earning from assets, but the earnings are so good, it doesn't matter. So that's basically the three things I'm looking for. Margin of safety straight off the bat. If I can't have it, I'm out. Try and take a leaf out of Merge for Buy's book where you say no as fast as you can, hopefully within a few minutes, and we're going to see if we can do that here. Basically, we've got no downside protection from the assets, so what is the cash flow like? We've also got to have a look and see, have they got any debt? Okay, interest-bearing debt doesn't look like they got any. Net cash flow from operating activities, 300,000. Position of intangible assets, purchase of investments. So that's not. I would imagine that's not fundamental to the running of their business. This will be. So they sort of cancel each other out anyway. So 200 million in free cash flow. Okay. Just from an income statement, have they got any interest expense? G&A. Not by the look of it. So they can't have a lot of debt. How many shares outstanding have they got? $50 million, say 50 million. ballpark figures here. So what did we say? 200 million. So 50 million. Or what is the market cap? We've got no debt. What is the market cap? CRTO. Billion, effectively. I don't know. I can't see anything in this. Let's just drag it quickly. I can't see any downside protection. CRTO. So I'm sure I've done this company before. What I need to do, I haven't done it the last few times I've done videos, and I need to. So that tracker that I just pulled up. That tracker that I just pulled up, every time I go for a business, I try and write notes on it. So if I ever come across it again, I can just pull up the notes and see what I saw last time. What's happened there? Jumping around a bit, isn't it? There we go. Must be me doing something wrong. Let's just make sure. DTM, what did we say? 300 million. They've only got 100 million in. What's that? 10k. 12 months, yes, that's a 10k. And we're saying 100 million. Acquisition of intangible assets. And so this data, not saying that, is it? That's because there's nothing in here. Look. The data's incomplete. Got there 75,310. Should be 102,739. Just dragged it off screen a minute. So what did I say? We need to minus 75. So 27,429 needs to go in the zero. In here. Needs to be negative 27,429,123. Boom. Now 102 million. There you go. So now we're right. You have got to keep an eye on. I do like white sheets. I like it a lot. It saves me a lot of time, and it's very cheap compared to comparable products out there. Like everything, you've just got to be alert to some of the data. Sometimes their algorithm doesn't pull it in correctly. They will correct it if you get hold of them. I have done that before, and they've corrected it. They're very apologetic, and they're quite quick to respond. Yeah, 288. What are we trading at? 17. What's the enterprise value? Okay. So we're trading on quite a low multiple. Simple free cash flow yield of 20%, that's quite high. Against the enterprise value. Wonder what the news. What's caused the downturn? AI-driven commerce innovation, new partnerships. Companies advance its AI-driven commerce platform with new agentic performance retail. Okay, that's what I was going to say. What were they earning? Well, supposedly they're better than they were, although return on capital is less. Book value's grown. Tangible book value's grown. Gross margins have got better. Revenues have declined. Not by a lot, but they have declined. Share count's declined as well, mine. I wouldn't say it's cheap, but it's not ugly, is it? Current ratio 1.27. What have they got on long? What's why she's got a total $1 million. It's not ugly, is it? I mean, it's not necessarily cheap at $17-18, but this seems quite high. What's caused the simple free cash flow to go up? Payables have come down. They're getting paid quicker. No inventory because that's not what they're selling. It's not the type of business. But something has happened, hasn't it? For free cash flow to change like that. Is this data correct? Look at 10K. Not exactly saying no fast at the moment, are we? Probably should be, just considering where the price is compared to the potential free cash flow multiple. And given the, like I said, the AI environment is currently going ham on advertising companies. Receivables. They took a load of receivables. Look, there's a huge swing in receivables. But there's also a huge swing in payables. A lot of those receivables have obviously gone to pay off some stuff. Okay, so they sort of cancel each other out, don't they? Where was payables last year? So they've cut them down quite a bit. Leases, a lot of leases. So how much of the assets are leases? 34. Saw that earlier. I don't know. I don't think there's enough here that's cheap enough for me. Let's just start a new conversation. Explain. CRTO. Ticker CRTO. This is ChatGPT here, but I have found recently that I believe Grok is better now. Global advertising technology company, brands, retailers, personalized ads, retargeting, that's right. So you look at something and then it brings it up again. So have a look, see if I got Criteo in here after all. Yes, I have, right at the top. What did I say last time? Gave it a value of 13 to 14 last time. And it's come down from almost 22 that it was previously. This is before, I will say this is so early on in my thing, this is before I was margin of safety first. So AI-driven targeting, self-service tools, so revenues, retail media, performance media, not majoritively in America. Semi-equally split between America and Europe. In the middle of changing what kind of company it is, historically made most of its money from retargeting. Now it's trying to become a commerce media and retail media platform like Amazon adverts. Transitions take time and capital. Plans to move its legal headquarters from France to Luxembourg. Low insider ownership. Doesn't own a big stake. What was it last time? Insider ownership unknown. Great. Oh, that was one other thing I didn't check with Harley-Davidson actually. I shall do it. Oh, here we go, look. Day sale payable got better by 14 days, but it was more than double what it was 5 years ago. Let's have a look at that. Is it still the same? Yeah, here we go, look. 100, 230. Yep, still more than double what it was 5 years ago. So sales are coming down. What did I say then? Period performance, TTD. Buybacks could increase. So revenues of 1.85. What did they end up being? 1.94. So conservative. Yeah. Free cash flow margin has been around 4%. Let's have a look. We went up to 5, but yeah, historically 4 or 5. Looks like not a lot's changed, doesn't it? 13 to 14. Be conservative. I used 80% of that 4%. That came out of a multiple of 17.6, which is quite high. Apparently the peer average is 13. Yeah. So no, there we go. Look, I've done it before. And what moment did I do this? 31st of October, so 6 months ago. Half a year ago I looked at this, and off the face of it, just from the financials, doesn't seem like a lot's changed, does it? There we go. This is why I've got that tracker, so I can look back and see. So let's just have a look at the Harley-Davidson stuff a minute. There we go. CC hog, because I want to put that in my... When was the last time I did it? And the bloody amended one. I find that in the 10K. Normally in this, they haven't done a searchable one since here. It's a whole year ago. What was the insider ownership back then? We're just going to have to use that. Beneficial. I do like to see high inside ownership. Here we go. All director. Oh, less than 1%. Amount shown is less than 1%. So all the directors own less than 1%. That's not very good, is it? It's not. I don't like that because it's not you believing in your company. Let's put that in here. Where was Hog? I didn't put it in Sirius XM actually either, because once, yeah, Berkshire bought a huge portion of Sirius XM. Where are we, Hog? It's down somewhere. Here we go. Less than 1%. Not cool. What did I say a value was? Right, 22. Persons. Ali. DFS. Who was the other one? Polaris, wasn't it? What's Polaris's? Say P. Bly. Right. HDMC. There we go. Alright. I may just write in here C, because I saved that other document. C, Word document. Just so in the future. So, moving on from that. CRF, what's this? Funds, I'm not interested. Acco brands, I've looked at these recently as well. She noticed the other day that most of the stationery in our office, I don't work in an office, but in the team leader's office, is all Acco brands. Oh, I don't know. You got a lot of competition coming from cheap land, like, you know, cheap labour countries for this sort of thing. What did I say they were worth? Pardon me. Where is it? Why is it not showing? Look at it. Counts. Here we go. Oh, I didn't put a value on it. Oh yeah, I did. No, I didn't. Why did I not put a value on it? Historically, it's traded around 9 times EV to free cash flow. Normalized average earnings are around 1.17, so 9 times would be $9 a share. But to be conservative, I've dropped it to 7 times multiple. Current interest expense 47 million annual. Normalized free cash flow is under 20 million, so will be covered, but it's very tight. And currently it has 59.6 million free cash flow. Yeah, it's barely covered currently. Debt is due 2029, likely to have refinanced if enough free cash likely have to be refinanced. Very difficult business compete with cheap Chinese alternatives. Revs have continually dropped since before COVID, having to compete against these markets. Likely a dying business long term. You can buy for under $1, then it's a buy. We are not under $1. Has it ever been under $1? Yes, down here. That's why I said that then. I mean, you're going right back to the financial crisis, mind. There's no way you're going to see these levels again. Not unless something happens to the Chinese market. Just do a quick balance sheet look at this. As we got a 10k in. Balance sheet. 64 million cash. 360 million. Inventories. What would you take for the inventories? Surely inventories in a fire sale for something like this would be... Oh, I don't know. So what are we going to say? 300 million total between cash and accounts receivables. We plant equipment. Half a bill. Inventories. Oh, what percentage would you prescribe to that if you wanted to sell that in a fire sale? Probably less than 50. And then, what did you say there then? What do you say? 300 million between there and there. 800. I don't know. We just take it at face value. 800. Goodwill's huge. Fuck that off. Intangibles is huge. Fuck that off. There's no downside protection. Total liabilities of 1.6, and we're saying effectively we've only got a liquidation value of around, at best, $1 billion. So not interested. Current portion of long-term debt 30, accounts payable 186. If we go on the cash flows this year, 68. Been disposing of assets. Look. Profit plant equipment, that's gone up. Using this as a proxy for free cash flow, what we need to do is see if it's in line with depreciation. Not looking at the wrong one, aren't I? There, 26. So historically, depreciation was a lot higher. Which probably shows that the business is shrinking. 40 million. Look at that, that's way down year on year. What has caused that? No impairment charge this year, whereas historically there has been. Accounts receivables. way down. Inventories. They've either sold nothing or they've done nothing with the inventories this year. Statement of income. Net sales down, down, down. Oh, got something right. Lost my train of thought now. Balance sheet. What's the inventories done on the balance sheet? Gone up. Okay. Payables are positive, so it's 10 million more than what there should be, so that's worse. How many shares outstanding? 90. There's like 50 cents free cash flow. Like I said before, probably a long, dying business long term. I have got a fucking watch on it though. I don't know why. Maybe in case it comes down to these levels. Let's draw this on here. We'll see if it comes down here. Not interested though, at all. Not really sure why it's got the blue. Maybe just keep an eye on this dollar level from that note previously. Division of Financial Technology Solutions in Brazil. So I'm probably not interested in that either. Not a lot of data either. Look, what have we got? 5 years, 6 years of data, 8 years of data. January 2018. It's all fucking 6K, isn't it? Oh, we have got one here. Look. Cheat. Here we go. In thousands. Total current assets 65. Non-current total assets 75. What have we got? In thousands. All amounts in thousands. Oh, yes. What's the fucking exchange rate? This is what makes it complicated. Brazilian. Currency to US dollar. 20 cents. Cents. So what have you got? There's that trillion. Okay, can't be bothered. It's too complicated for this time of night. What was the number? Let's just put it in just to see. Pardon me. 2, 3. Saying. $2 billion. Really? Anyway, alright, we're going to move on from that one. It's too complicated for this time of night. It's not really the sort of company I like anyway. I find it very interesting actually. I was listening to an interview with Monish Pabrai the other day. Yesterday actually, and he doesn't invest in financial companies despite that being his background. I thought that was quite interesting. Digital marketplace for home services. Another advert one, is it? No, hang on. Find local pre-screen customer rate professionals, okay. Like a trade finder. And it is doing awfully. SEC, Angi, 8K, 10K. Balance sheet. 300 million in cash. Accounts receivables, let's say 20. 320. So the majority of the current assets pretty good. leasehold software. Good fucking goodwill. Look at that. $1 billion of the 1.7 is non-tangible. And we've got total current liabilities. 500, 700, 750, 250 million in assets. Cover page. 40 million shares. $6.25. Okay, so you are close on an asset level. Maybe we'll come back to this one. Cash flows. 105. 40. What's the play thing again? 40. So $1. $1 in free cash flow. If this is all legit. What have we got? Stock comp. I fucking hate that. Get rid of that. Provision for credit losses has come down. Appreciation. Semi in line with capex. $1. So it's trading at 8 times. What's the debt? Long-term debt. There is long-term debt. 500. So what did we say? 40 million was the interest expense this year. Fuck. Oh, there, 20. Okay, so there's wiggle room, isn't there? They could lose some 50% free cash flow before they get in trouble. Just couldn't find it then. This is looking in the wrong fucking place. Let's fuck this one off. Have we looked at any of the others? No, because I got that on. Decided not to look at that. Angi. Alright. Let's just get this company filled out into the spreadsheet. I just dragged it down off the screen a minute just so I can work and go. I'll dictate to you what I'm writing in. Come on, get down. AMC. Did that the other day, didn't I? That was on a video old class when I wrote in. So at today, put today's date in, ticker, Angi, Angi Inc. Current price is 810. Right, let's drag it into the spreadsheet, shall we? One thing I want to do as well, what I haven't done yet, I want to use the diluted shares as opposed to the. I don't use in my spreadsheet, I don't use it against the diluted shares. I should, just to be conservative in case a dilution ever comes to fruition. At least I think I should. Other people could disagree, I suppose. Ooh, here we go. Beer. 75 cents. I said around $1. Is the data correct? $22 in revenue. Interest coverage 1.7. Interest expense 4 cents a share. Share count 6. Revenues have come down though significantly. Gross margins are 90%. Of which supposedly 80% goes on fucking SG&A. What are we saying is in here? 100 there. Oh, fucking, what have we got? 35 million in free cash flow. $35 million. Oh, because we're taking the stock-based comp out of it as well. Okay, which is what I wasn't doing on the top one. I was looking at the 35 million in free cash flow is 75 cents share, yeah, of 46 million shares outstanding. It's not cheap, is it? 15 times against EV. Why is that there? Let's just ask what it does. Here, new chat. Explain. Ooh. Oh, so fucking high again. Ticker. Angi. Let's just see what it does. Angi. This one. GI. See who's holding it. Anyone of any conviction is what we're after. Oh, couple. You must be an insider. Not mentioned on here, but just do this. In here. New there is. Google him. Barry Diller. Chairperson of AIC. Fuck is AIC? Oh, Fox. Why he owns this company? It mentioned in here. Oh. Is it the same Barry Diller? Probably only one, isn't there? IAC, there you go. It's the same Barry Diller. What is he seeing in this crap? When did he first own? Doesn't say. Quarter first own, doesn't say. Right, anyway, let's just see what they say here. Online marketplace connect homeowners with home service professionals. Yeah. Okay. Copy paste this into the business model section of my tracker. What it actually does. Major brands. So let's see what they own. Never heard of these. My Hammer, never heard of it. Some services, Andy handles the entire transaction, taking a cut. Companies controlled by Barry Diller's internet conglomerate. Yelp. struggle with contractor dissatisfaction, low quality leads, competition. So what's that going to be? Future risks. Copy and paste all of that into the future risks section. If the contractors don't like it, are they going to keep using it? Probably not, you know. Sorry, I'm just formatting. Did some formatting on my fucking tracker. Right. Right, okay. So, why the stock has fallen? I've got reasons for decline. Declining contract spend, transition to new services model, competition from newer marketplaces. Got it in here? Yes, I am. Alright. We had a quick go through the balance sheet just now, didn't we? We've already gone through the cash flow statement. I think it's a no-no, just because of the amount of debt. What was the enterprise value? $500 million. So we're already trading at like fucking 16 times on the simple free cash flow, which has dropped significantly. So it's a no, but what I will do off screen is I would just put it in my tracker, just so, like, with Criteo, I can go back to it if I come across it again. Doesn't mean it's going to stay as a business I don't want to invest in forever, does it? You know. Anyway, right, we've done what we've done. It's an hour and 10 minutes, so I'm going to leave this one here. As usual, I will say that I'll try and get you another video quite quickly. I hope that to be the case. Life gets in the way. We'll see. But just remember, everything I said in this, I ain't got a fucking clue what I'm doing. I'm literally trying to see whether or not I can become a successful investor after teaching myself everything that I know. I have had no education, nobody. I don't know anybody in the financial industry. It is literally just me taking an interest one day, seeing whether or not I can do it. So basically, I ain't got a clue what I'm doing. Don't fucking listen to me. And I'll see you on the next one. Like and subscribe. I keep getting told I don't say that, so like and subscribe. Thank you very much, and goodbye.